Hi, I'm Grant Abbott. I'm Director of Now Infinity. I'm with Rob Richards from Rob Richards and Associates, and we're talking trust distributions and the importance of getting our minutes in by 30 June. So obviously the Commissioner's going to play hardball. If you get audited, there's obviously problems for the accountant who hasn't put it in place. Huge problems for the client, obviously going to be taxed at the marginal tax rate. But when we do our distributions, what do we need to do? Because I know you're a really big one on specificity.
Well, in terms of the starting point, first of all, to make certain your resolutions are correct.
Correct.
And that's a question of making certain they're done before the 30th of June.
Tie in with the deed, of course.
Tie in the deed. Well, obviously your deed's got to be correct to start off with, because you've got to make certain that the beneficiaries are the right beneficiaries. I've got a couple of matters on, because I'm seeing people today actually to see if they can change their deed to bring in beneficiaries before the 30th of June, so they can make distributions to beneficiaries which the deed doesn't allow them. So perhaps that's their starting point. Perhaps I jumped ahead when I said resolutions. Your starting point is to make certain that the deed allows you to make distributions to the particular people you want to. Now, normally in discretionary trust deeds, you've got a family trust or whatever, but what happens, for example, if you happen to have a company or a share in a company or a share in a unit trust, which has perhaps got tax losses in it? You would
obviously want to distribute it to them.
To them. And that may mean that you've got to amend the deed so that you can bring in another beneficiary which wasn't originally looked for.
Which is looked at a lot. No resettlement issues there, or?
I don't believe there's resettlement issues. I don't believe the fact
there's a lot of cases around that one.
The word resettlement's a silly word, because there's no such thing as such in terms of what the problems are on resettlements. What we are looking at is whether there is a trust. It's right, the new trust, whether there's a transfer of property. And what the tax office will argue, or was arguing, was that if the terms of a trust are so fundamentally changed that there has been a transfer of property from Trust 1 to the new trust, that gives rise, the tax office would say, to a capital gains tax event. That's not a resettlement as such, that is a actual transfer. Now, I think there's enough cases now to show that if the changes are changes which fall under the trust deed as originally established, or as established, that will not be a capital gains tax change. Sometimes you don't want to take the risk, but if the assets in the trust are only cash or something like that, there's nothing to worry about anyhow. So far as stamp duty is concerned, stamp duty is not an issue on that. So amending the deed is not, I don't believe amending the deed is something to concern people about, but obviously it's something which you should always think about, just to make certain you're not doing anything stupid.
So pre-30 June, the important one that you're saying is check your deed.
Well, that's number one, I guess.
And then check your beneficiaries.
Yes.
And then move on to your distributions planning.
Then move on to that's right. And I jumped ahead when I actually said your resolutions, because the actual thing you have to do, you must do, is get the resolutions done before the 30th of June, or otherwise you are going to have income to which no beneficiary will be presently entitled, which would mean to be taxed under Section 99A at the maximum marginal personal tax rate.
Which means if that's going to happen, you might as well put it straight into your superannuation fund, which is taxed your marginal tax rate, and that's in a competitive environment.
Yes, that's what I would do. The only problem with that would be is the tax office might say that's a contribution, and that could be the worst of both worlds. You'd be hit
triple time.
Well, the excess contribution rules aren't so bad now, so we don't have that's manageable. But it's what the tax office most rarely say. The tax office in a ruling has got out and says in its ruling that
increase in capital
is a contribution. I have a little bit of technical problem with that, because it would seem to me that income is one thing, contributions is something else.
Oh, absolutely.
So say if something's a contribution, how can it be income? So I don't think the tax office can have the best of both worlds.
No, I mean, we've written, again, going back to, obviously Bamford and the construction around the rules, I've written into the deed is the fact that distribution, if you did do it from a trust into a superannuation fund, you actually put it into a reserve, much the same as the old defined benefit funds, to which no one is entitled. Because if it doesn't go into a member's account, obviously can't be a contribution. But get our distributions in prior to 30 June, absolutely crucial, and I'm sure we're all going to do that.
Then, of course, you have the question of whether you should make a payment or not. I suppose that there could be an issue that if you don't make payments or distributions, this is just a Part 4A issue, but that's not normally a situation unless you fall into the distributions to a private company and you fall into the situation where that's a deemed loan.
Yeah.
These sort of,
7A stuff.
that's right.
Perfect. Anyway, it's Grant Abbott, Rob Richards from Rob Richards and Associates, just signing off.